Every major financial crash in history was predicted by almost nobody who mattered. And that's not bad luck. The people we trust to see it coming are psychologically wired to miss it. Every single time. We assume the smartest people in finance, the economists, the hedge fund managers, the analysts on your screen, have some kind of early warning system. That if a real crash is building, they'll spot it weeks out and we'll get a heads up before the damage hits our portfolios. Here's what nobody tells you. The more confident an expert sounds about calling a crash, the less likely they are to actually be right. And this isn't a hunch, there's research on it. And it's brutal. Political scientist Philip Tetlock tracked over 80,000 predictions from professional forecasters across 20 years. The average expert performed worse than random chance, worse than flipping a coin. So today we're breaking down the actual psychology that makes crashes blindside even the smartest people in the room, and more importantly, what you personally can do so you're not one of the casualties when the next one hits. Let's start with why the experts themselves get it wrong, because this is where it gets uncomfortable. It's called the illusion of control, the bias where people believe they have far more influence over unpredictable outcomes than they actually do. Analysts build increasingly complex models, and the more variables they add, the more in control they feel. But complexity doesn't equal accuracy, it just hides the guesswork better. That's why so many forecasters missed 2008 entirely. Their models were sophisticated, but they were built on the assumption that the housing market would behave the way it always had. When you understand this, you stop outsourcing your financial judgment to anyone who sounds certain. Certainty is the red flag, not the reassurance. That works, but knowing experts are overconfident doesn't explain why crashes actually happen the way they do. And this next part is the real mechanism, so stay with me. Crashes aren't caused by bad news alone. They're caused by a feedback loop economist George Soros called reflexivity, where falling prices themselves cause more selling, regardless of what the underlying business or economy is actually doing. In 1987, so-called portfolio insurance programs were designed to automatically sell as prices dropped, which triggered more drops, which triggered more automatic selling. The market lost over 20% in a single day. Not because anything fundamentally broke, just because the system was built to panic itself. Today, it's algorithmic trading doing the same job faster. This matters because it means a crash can start for reasons that have nothing to do with facts. It's contagion, not information. And that changes how you should actually protect yourself, not by trying to out-analyze the market, but by not being structurally exposed to a stampede. Which brings us to the part most people skip, because it's less about the market and more about you. It's called normalcy bias. We underestimate how bad something can get simply because it hasn't happened to us personally yet. It's why people keep buying into obvious bubbles, telling themselves, it hasn't crashed yet, so it probably won't. The fix isn't predicting the crash. It's pre-committing to rules before emotion takes over. Automatic rebalancing, a cash buffer, a written plan you follow when everyone around you is panicking. That single habit does more for your long-term returns than any forecast ever will. If this kind of thinking is shifting how you see your own money decisions, subscribe. Here's the takeaway. The experts aren't lying to you, they're victims of the same biases you are. Crashes spread through panic, not prediction, and the only real edge you have isn't calling the top, it's building a system that doesn't need you to. YouTube told me that this video might be for you, so you might as well check it out.